Changing regulation for the future. I put these slides together about a week ago, so I can't necessarily tell you that they're still accurate. Things have probably moved on even since I put these slides together. So that's the agenda of the talk. I'm going to break this down into where we're coming from, what we currently have in process, and the future and its challenges. The background. Everybody always points back to the flash crash on the US markets. It happened, so far as I know, there is still a little controversy about how and why, but a large number of the high-frequency trading firms will tell you and anyone else who is prepared to listen that it wasn't them who started it. I am focusing my talk today on high-frequency trading because that's where most of my clients find themselves. So apologies if I'm missing out on any of the lower frequency trading stuff. Mr. Ray and others spoke very eloquently, to borrow a phrase, about the more general landscape of trading on exchanges. But seeing as regulation at the moment is focusing on high frequency and technological advances, that's where I'm focusing my talk. We have, since the credit crunch of 2008-2009, lower volumes on global markets, and we've already discussed those in relatively granular detail this morning, and for the reasons why they are there on both the equities and derivatives markets. The impact, at least as far as I see it, of lower volumes on global markets is that more people are fighting for less liquidity. There is a lower opportunity for everybody to make money. Some of the investors on at least the retail end begin to feel disadvantaged because they do not have, so far as they feel, the access to technology or information and data that more experienced, sophisticated, or better capitalized and more well-established firms have. I would posit that quite a number of the problems that the market is experiencing at the moment stems from that situation. If global markets were continuing, if house prices continue to rise, we'd all be very happy. If debt was available to all as it was in the days of the pre-financial crisis, who'd be complaining? We'd be trumpeting the development of technology. We'd be the world of the financial global colossus would still exist. Everyone would be very happy. However, we're playing in a radically different environment now, and it leads to a certain amount of disgruntlement, and that has, rightly, in my view, focused attention on regulation, on risk management, on price discovery, and the interconnectedness of markets and contagion. I've mentioned the global crisis. Changing technology. There has been some consternation, and I don't know how many of you were in the HFT streams yesterday, but it was brought up there that the exchanges and the MTFs and platforms have diversified their order types, made them more complicated. We start with 3, we now have 25, we have 30, and the feeling amongst some market participants is that the expansion of the number of order types has been focused on attracting high-frequency algorithmic and automated trading firms to their markets because they provide liquidity. I suppose we can get into the argument of what is not liquidity and how good or bad that liquidity is, but certainly there is a reason that platforms have introduced a greater number of order types. They obviously believe it's a good thing. Access to markets, before Pontius was a pilot, there were a limited number of ways you could access the market. Now you have non-clearing membership, you have direct market access or sponsored access. There have been moves within the United States to limit that access from the risk management point of view, and there are similar feelings on this side of the Atlantic as regards the risk that can be posed by a firm which has direct market access naked. And so steps have been taken to try and reduce the nakedness of that access. We also have increased market fragmentation. I believe that this is one of the unintended consequences of the original MiFID process. In order to bring more of the venues within the regulatory umbrella and to increase transparency of and access to the markets, we have created a trading environment which is fragmented but nonetheless exceedingly closely correlated. The ripple effect is a phrase you may have heard used. You bring down one market and you can bring down many. If you can trade one product in one market knowing it's highly correlated to another, you can affect directly or indirectly the price of the asset on the other market and have a similar effect on a market which is apparently completely unconnected. Right. Like I said, this is a list drawn up last week, so things have changed. Current legislation in process, we have the MiFID review, which is ongoing. The goalposts move ever so slightly every couple of months. We've got the Market Abuse Directive. I included the ESMA guidelines on automated trading in the headline of current legislation in process. Admittedly, they came into force in May last year. But the interpretation of them and how they will be implemented by the EU competent authorities is a work in progress. The ESMA guidelines are also being looked at constantly on an ongoing basis by the market to develop best practices. And as we go forward, service providers will be confirming or having independently confirmed for them that their processes, policies, procedures and services are ESMA guideline compliant. It is still a work in progress. We also have member state specific legislation and regulations being brought in or under discussion, similar to the financial transaction taxes that France and others have already imposed, and the group of 11 has under discussion. The specific laws on HFT are causing, I don't wish to use too strong a word, consternation amongst certain market participants. We reach one deadline where we are promised that the legislation will be tabled. That deadline passes, nothing happens. There are conflicting views within the marketplace as to what provisions will remain in the laws and what will be negotiated out. It's not entirely clear who is negotiating what and how. as you might expect with legislation. The main difficulty with some of these things is that we're front-running the MiFID review. I couldn't possibly tell you why the decision has been taken to do that amongst individual EU member states. I have some thoughts as to why that is the case, but I will probably not wish to share those in open forum. The upshot for at least the buy-side community and those who work with the buy-side community, the executing brokers, those who provide direct market access and sponsored access, is that nobody really knows what the landscape is going to look like. And the time horizon of MiFID 2015, whenever that is going to be, that's been brought forward quite significantly by the fact that member states have their own unilateral laws in process. We have the financial transaction taxes. Again, the Italian law and the French law, which we already have, look remarkably different to the laws, or the framework of the laws which have been tabled by the 11 EU member states who've decided to press forward together with it. I can't tell you why the laws that the French and the Italians have chosen to implement look different from that which we're discussing on a wider forum. Again, I can speculate privately. We have the US rules in process. I've written down specifically the CFTC rules, including Rule 173. You have 15C35 as well. Rules 173 I will touch on later as well in terms of taking liability for others' positions and risk management. It's a process that firms on both the buy side and the sell side are grappling with at the moment. Pre-trade risk management is all very well, but there are some instances where we're being asked to pre-trade risk manage potential liabilities which are exceedingly difficult to quantify pre-trade on the give-up, for example. That is leading to, or at least it should lead, so far as I'm concerned, to a discussion not just between the compliance departments of firms and the regulators, but also the technology and development sides of firms, their compliance guys, and the regulators. It's indicative, and I will touch on this as we go, to the fact that part of the result of the changing face of regulation is that firms need to become more, and I really hate this word and I do apologise, but I've never come up with an alternative, more holistically managed and operated. The distinctions between various departments, Chief Operating Officer, Chief Financial Controller, Chief Risks Officer, traders, is reducing every single day. Oh, we have the short selling bans and their exemptions. The exemption is interesting because part of the discussions that we're having at the MiFID level is to force those who say they provide liquidity to provide that liquidity under pain of regulation. It's good to see that there are market-making exemptions available in some of the short-selling bans. The market-making exemptions to various of the member state-specific FTTs and HFT rules are not so clear-cut, and that again is going to be under discussion. Industry initiatives. What are we trying to do about it? Top of the list is the Futures and Options Association's Guidance on Electronic Trading, which was published September 2012. I put it top of the list because I was involved in it, so I'm quite proud. It is part of the work that has been conducted and is ongoing in relation to the ESMA guidelines. It is an attempt by the industry on a 360-degree basis to develop best practices. It has had a number of intentions. First and foremost is the intention to create best practices within the electronic trading industry. Second is to discuss with those who are involved in the MiFID review to show them that high-frequency trading, algorithmic trading, automated trading, whatever the definitions you want to use, or that the European legislators are using this week, is not in and of itself abusive or a bad thing. The last use for the guidance was to drive an understanding from some of the lacunae that we saw in the ESMA guidelines, to fill in the holes, to fill in the principles with actual hard facts. We have similarly best practice guidance issued in various areas by the Futures Industry Association on the other side of the Atlantic. That is exceedingly helpful guidance and differs mainly from the FOA's guidance in that the FIA's membership is much more buy-side specific. So it's, if you want to be in our gang, this is what you have to play. We have a number of responses to consultations on both sides of the Atlantic which are ongoing. Now, I've put down here unintended consequences of openness with regulators. The reason that's there is that there is a certain feeling amongst some of the buy-side firms that in being open with regulators, responding honestly to consultations and giving hard facts, figures and some of the data sets that are available, like their order and trade data, they're merely being given enough rope to hang themselves. That is, I'm sure, unintended from the regulator's point of view, but unfortunately it's not just the regulators with which we have to deal, it's the politicians as well. I do my best, as do many others within the industry, not the least of which are gentlemen like Remco Lenseman from the FIA EPTA group, to discourage that type of feeling within the industry, but still it is definitely out there. Now, HFT 9000 question mark. I am reliably informed by Mr. Van Vliet that it's no longer HFT 9000, it is AT 9000. These are a set of rules and principles which will be independently audited based on the ISO 9000 standards, which are under discussion within the high-frequency trading community. The intention has numbers of folds, not the least of which is to prove, in the same way that we were trying to do with the FOA guidance and the FIA best practice guidance, that the industry is playing nicely now. So hands up, we know that some of our members of the community haven't played so nicely in the past, but the majority of us are good market participants, and those who do not wish to partake of our best practice are going to become outliers, and we want nothing whatsoever to do with them. Go get them. Whether or not that progresses, and I do hope it does, will be a question for discussion with actually the regulators and the politicians, because there is a little feeling, again amongst the buy side, as that by looking to create ISO 9000 type standards for a community, all you're doing is giving the regulators and the politicians even more rope to hang you with. It's not an either or, ISO 9000 or regulation, it's both ISO 9000 and regulation. Whatever the industry does as regards best practice, independently audited or otherwise, is not going to be good enough. Academic research, I was thinking particularly of the Foresight Committee's report towards the end of last year, which was both critical of and gave some praise to the automated trading industry. I mean, it came up with some home truths about the possibility of negative feedback loops within algorithms, which is true, but it also, so far as the data sets that were available to it, gave a lie to the fact that high-frequency algorithmic automated trading has increased execution costs, has lowered liquidity, etc., etc. But saying that, there has been a large body of speech against the findings, and you know, even talking about, they called it tobacco research, because some of the members of the Foresight Committee were in the industry. So we have a lot to play with, and we have a lot to think about. The future of regulation, well, it's all out there. We have statutorily mandated order-to-trade ratios. We have statutorily mandated minimum tick sizes. We have the regulation of high-frequency firms from MiFID. We have compulsory market-making obligations, which are possibly on the horizon. We have the liability for others trading. We do not have, but will likely have, legal entity identifiers and registration of algorithms and disclosure of strategies to regulators. Now, back to the first two, order-to-trade ratios and tick sizes. There is a drive to make these statutorily level 1 mandated. I believe I speak for the industry when I say the proper place for those to be set out is at the exchange level. It is exchanges who issue their order types, it is the exchanges who understand their market participants, and it is for the exchange, on the basis that they understand that their obligation is to create and maintain a fair and orderly market, to implement those two. The last two, LEIs, registration of algorithms, and disclosures of strategies. All sound good in principle. I would like to know how we can do it in practice, how it is possible for the industry not to be accused of attempting to game the system, because my strategy, well, I'm running an aggressive ARB strategy. What would you want to know? I'm a market maker. There are various ways of disclosing a strategy, and in order to register an algorithm, again, it is difficult for the industry not to be accused of gaming the system when you have algorithms which generate the orders from the strategy, but then get pushed through an aggregator which goes to the best execution, which points them or breaks them down into manageable bits. So how do you avoid being accused of gaming the system when it's not absolutely 100% clear what algorithm it is that you're expected to disclose, or what exactly constitutes a strategy with which the regulator is concerned? There are a lot of challenges for the future, not the least of which is the extraterritorial effect of legislation. We have the Europeans and those on the other side of the Atlantic, both of whom are concerned about firms which trade in their markets, come under their nominal jurisdiction, but are not home resident. We have changes in approach to management style, to how firms can trade into new markets, taking the German HFT law as a prime example. If a firm that is a direct or indirect, query what that means, member of a German exchange has to become licensed by BaFin or passported in by another EU competent authority, it is no longer possible just to have a co-load server on an exchange. The brass plate approach is no longer going to work. You're going to need people. That's a fundamental change in the way some of these firms are run. We have the issue of intragroup services and transfer pricing. The tax authorities around the world are going for the multinationals, but while they're going for the multinationals, the smaller groups who nominally fly under the radar also need to be concerned that the tax authorities are going to be looking at their intragroup services arrangements and the transfer pricing of those arrangements, even within the same jurisdiction. We have VAT, reverse charge VAT. It's coupled together with the fact that we're going to have to fundamentally change the way that these groups are structured. If you want to trade in markets that are going to insist that you are regulated, then there is a lot of work to be done over the next few years. That's my contractually mandated thing about who to contact at Vedder. In summary, because I know Colin's been standing there for at least 5 minutes when he was supposed to be there 5 minutes before I was supposed to stop talking. The markets are in for a rough ride, I believe. The ride would be smoother if we knew what the end game was going to be, what it was that the regulators, sorry, I beg your pardon, the politicians wanted the markets to look like in 2 or 3 years' time. But there isn't a large body of evidence that they do know what they want the markets to end up looking like. And until the wheels stop spinning and we see what the regulations are going to look like at the end, then we're either in flux or in stasis, one or the other. We can't build businesses, we can't significantly expand volume, and there's going to be a lot of argument.